Thanks for joining us here on Market Call. I'm Morella Fernandez. Andrey Omelchak is on the show today. He's CEO and CIO, LionGuard Capital Management, taking your questions today on North American small and mid-cap equities. Here's how to reach us. You can call toll-free 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Andrey, thanks very much for coming in.
It's great to be here, Morella. Thank you.
The last few months, of course, have been quite a ride for investors, as you know. You say panic pricing has sort of settled in. Can you explain what that is?
Well, you see, the market is composed of thousands and thousands of securities. And somebody who understands their value, the intrinsic value, can really find a lot of bargains these days. I'm not making a call on overall market values. We can debate that. Market multiples versus the premium you get versus 10-year, fixed, and we can make a case that market's expensive, for example. But at the same time, if you look underneath and you analyze individual securities, we can see really panic level type of prices, even for the higher quality securities.
Okay, so what are the higher quality businesses that you see are, I guess, getting caught up in this downward spiral?
Sure. Everything you hear every day today, especially in Canada, is about tariffs. Mm-hmm. And of course, it's well warranted that some securities and businesses will be impacted. It's well warranted that consumer confidence is at all-time low, and business confidence as well. At the same time, there are a lot of securities which are not impacted by tariffs at all, where underlying businesses are doing really well, and their business prospects are good. Yet they've been caught in this fund flow dynamics when nobody wants to invest in Canada. For the time being, there's a negative fund flows outside of Canada, but at some point, I think it's going to reverse in opposite direction, and we can discuss why. And I believe it's really a good time to pick at those securities and to buy them at these levels.
Okay, so when and if the tariff whirlwind, I call it, settles down, what are you going to be looking at?
Well, I think at some point, like with all the major news, be it on geopolitics or be it on economic front or whatnot, there is a natural fatigue that settles in. Usually it takes several months or quarters to do that. And I believe that we're going to settle in a world of tariff fatigue in Canada, when investors are going to be able to dissect securities which are impacted by tariffs and those which are not impacted by tariffs. And even if the news flow changes from the White House on a daily basis, these type of securities will be owned and bought by Canadian allocators and other allocators as well. And the fund flow dynamics will become increasingly positive towards those type of securities. So that's where you want to focus. That's where I'd like to focus most of my investment activities, so that I'm not impacted by the outside factor which I cannot control or predict.
But you say that takes normally several months or several quarters to filter through. And because it's the start of the year and all of this is just beginning, we're only in the beginning part of that cycle. That's
right. Okay. It's just beginning. It takes some time. But I have to say, we have already had quite a sell-off in number of securities. Year to date, a lot of securities are down 20, 30, even 40%. So there's a forward pricing of the concerns, and to the large extent, much more than warranted. Even if you incorporate the worst-case scenario on a tariff front, number of companies become very attractive buy levels at this time.
Okay, we are going to take a quick break, line up some phone calls for Andrey, who is the CEO and CIO, LionGuard Capital Management, taking your questions on North American small and mid-cap equities. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We want to get right to our first email today, which is coming from Russell. He says, hi, I'd like to know where your guest sees the price going for Propel Holdings. Andrey, what do you think of Propel?
Sure. Thank you, Russell, for the question. Propel is a great company, and the management team has done a really great job to build their loans and to deliver very good risk-adjusted returns. It generates very high return on equity, which is actually something I like to see. What I like about Propel is that they're able to reprice their loans at a very fast rate. So within 12 months or so, they can reprice the loans. Therefore, if they see any stress, they're able to adjust that with respect to the whether or not the loan is given to a given borrower and what type of rate should be charged for that. I think what we need to see is a diversification of the funding sources for Propel Holdings. And I think they're working very hard on that front. And should that come at some point this year, I think it can warrant a higher multiple. But I think pullback that the Propel has experienced stock price-wise is unwarranted. I understand everybody's concerns around the credit quality, but at the same time, as I said, they can reprice those loans very actively. Therefore, don't expect big non-performing loan formations and write-offs for Propel.
Do they have a chunk of money for losses in case they do incur?
Yes, absolutely. They have allowances which they build in case they need to tap into those, like any financial lending company would. And so far, the credit experience has been good. I also want to compliment the management team. They have done a really good job on acquisitions front. They made an acquisition in UK, highly accretive. So we're going to see benefits of that starting to play out over the next 12 to 24 months. So I think it's a good time to be accumulating Propel. And the pullback, once again, is not warranted, in my opinion.
Got it. OK, let's go to the phone lines. Jim is calling from Elliott Lake today. He has a question. Hi, Jim.
Good afternoon. Andrey, I'd like to ask you about the Canadian telcos. Rogers is in the news today. They all seem to pay healthy dividends. We all know what BC's dividend is. It seems that TELUS has been the best performer of the three. You know, your thoughts, do you own any of them, or are any of them a buy at this point?
So Rogers in the news because they announced a new deal to pick up the hockey games for the NHL, and people are worried about how much money they're spending and what they're spending on.
Sure. Well, if you're looking for the stable dividend paying stocks, I think it's a good place to put the capital to work. You can feel safe about those dividends, and if you want to stay on something safe, but don't expect to generate outsized returns, over an investment cycle. To me, you have to really divide the companies in different categories. Are these true long-term compounders? Are these in between? So there's really three categories. Or are these trading stocks? So I would put the telcos kind of in between category. You can clearly get your dividend. They're pretty well managed. If you're happy with that, yes. If you're looking for the yield. But I would not be accumulating them aggressively. I think that the rates they charge, by the way, on a global scale are very, very high. And should the more competition pop up in Canada, it's not going to be good for them as well.
Yeah, some are wondering, because they've dropped so much, like so many others, are they a good investment to sort of dip in? And if you already have them, add a little bit more on at this time. Do you expect to see a bit of a bounce back in the stock price?
I don't expect to see a big bounce back, but I think you're okay to accumulate slowly and to focus really on the dividend as opposed to the capital appreciation.
Got it. And a reminder, we didn't talk too much about Bell Canada, but Bell Canada is the parent company of this channel under Bell Media for CTV News and BNN Bloomberg. All right, let's get to our next caller. Andrew is on the line. He's calling us from Winnipeg. Hi, Andrew.
Hello.
Hi, Andrew. Oh, I think we just lost Andrew. So he did have a question on Well Health. Can you talk about Well Health a little bit?
Yeah, sure. Well Health is a great company. I really like the management team. They've done a great job on the M&A front. Now, what happened recently is that they had to delay their financials. That's not a good sign. They're saying that new financials are coming out literally in the next couple of weeks.
What delayed it?
A company that they own in U.S., which represents less than 10% of their overall EBITDA, is being investigated for various activities. So that's not a good sign. But they're saying it's part of the normal course, and this will be resolved, and this should not impact any of their plans. Now, it is a red flag for most investors, as it should be. Having said so, I like this management team. I have faith in their abilities to execute their long-term business plan. And given the fact that they made so many acquisitions, there potentially could be some bad apples. It's like in any portfolio, not everything works out. So we shall see whether this acquisition works out and whether these delayed financials represent a real red flag or it's something that is just going to pass. So
we don't yet know if it's going to be a longer drag on the company itself.
That's correct. I think over the next 1 month is really telling, and investors should watch very carefully for that. If they delay it further, that's a red flag for sure. But if it's resolved, I think then you have a strong buying opportunity for that stock.
Got it. OK, let's move on to our next caller. JC is calling from North Bay in Ontario. Hi, JC.
Hi, can I ask about premium brands? Do you think this is a good stock or potentially have some negatives with the tariffs? I hear they're in both in the U.S. and Canada and sell to a lot of different retailers that might be affected by travel and other things. What do you think of it here?
Premium Brands food processing company, of course. Are they exposed to tariffs?
They're exposed to a very small extent, not as much. What they're exposed to is the Canadian consumer. So if Canadian consumer decides to spend less money, decides to downgrade, so to speak, we can see an impact on some of the consumption of their products in Canada. Having said so, I actually profiled Premium Brand Holdings as one of my top picks last time I was on Market Call in December. And the reason for that is because they have added a lot of capacity in the United States. They invested hundreds of millions of dollars in building new capacity, which they're actively fulfilling right now. So that is a process, but it's progressing well. And over the next literally 12 to 18 months, we're going to see much more revenue and much higher earnings from Premium Brand Holdings. Also, there has been some concerns around their biggest client, Starbucks, in the United States.
They've closed some stores, they're restructuring, so there's a lot going on there.
There's a lot going on there. There are questions about their breakfast menu, where Premium Brands is exposed to. But during the last quarter, we have seen good indications that this relationship is working in the right direction. So I'm no longer concerned about the Starbucks, and actually it has become a growth client for them. So I think Premium Brand Holdings is very interesting at these levels. They're progressing in the right direction, and we're going to see good results from them, despite some of the economic concerns, especially in Canada.
Got it. Okay, we're going to take a quick break. Back with Andrey Omelchak, CEO, CIO, LionGuard Capital Management. Your questions today on North American small and mid-cap equities. Stay tuned.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back to Market Call. We want to take one of your questions that came in through an email from Roberto. He says, can I please get your thoughts on Air Canada? I'm looking at it for a hold for 12 to 24 months. Air Canada just reporting yesterday, of course, that they're seeing fewer bookings to the U.S., which is a key market for them, of course. They're seeing more transatlantic flights, and their stock has not been doing well for a while. We'll check in on the graph in a second. But what are your thoughts on holding Air Canada for a year? Will it bump back up? It's down now to $14.27.
Sure, Roberto, great question. I don't have a crystal ball for the next 12 to 24 months, frankly. And if you look over the last 5 years, Air Canada has not generated much stock price appreciation. It really goes in the category of a trading stock, not a stock you want to own for an extended period of time. And there are some legitimate concerns around their business and profitability at this time. There is new capacity coming onto the market. Consumers being much more cautious in this environment as well. So I can't say it's a great environment to be buying into the Air Canada. I think their free cash flow generation will be solid, but probably will still be under pressure from the past 12 and 24 months.
Got it. Okay, let's go to the phones. Gordon's on the line from Victoria, BC. Hi, Gordon.
Good morning. Guardian Capital Group, meaningful multi-year stock buybacks, a nice dividend that they increase at a good pace regularly, nice cash flows, reasonable PE, and a hidden gem on the balance sheet, the equity portfolio that they have. What's the future for Guardian Capital?
Well, I think, Gordon, you really nailed the important points for Guardian Capital. It is a high-quality name. It can remain dormant for a while, but when you get paid, you really get paid well. It has a good management team, very diligent capital allocators. And at the same time, they pay a nice dividend and buying back a lot of stock. So if they see a good accretive acquisition, they're going to do it, and they have done those in the past.
What's dragging it down right now? Is it the same thing that's dragging everybody down?
I believe so. I mean, equity markets been under pressure. They are clearly exposed to the equity markets. Multiples for number of securities are under pressure, especially for the asset managers. It is an asset manager, quite illiquid, that trades in Canada. So it's normal that it's under pressure. And if you can buy it on a sell-off, I mean, that's a good long-term buy. I really have faith in this management team and their ability to deliver long-term returns.
Got it. Okay, let's go back to the phone lines. Kevin's on the line from Hamilton. Hi, Kevin.
Hello, Andre. I wonder if you can give me your thoughts on long-term hold for WageX. It's come down a bit and has a good dividend yield, and is it sustainable? Thank you. Bye.
What's WageX?
Yeah, WageX, they do all types of industrial applications. They're somewhat exposed to automotive sector as well. It's a medium quality industrial company. It's not a long-term compounder. If you're looking for the long-term hold for the next 10 plus years, I think you're going to be okay to collect a dividend from that name. But at the same time, you're exposed to all types of risks, including on the tariffs front. I would not recommend to buy into the WageX despite seemingly attractive EV to EBITDA multiples, because it is a capital-intensive business. You need to invest in machinery, and that therefore this hides a lot the real profitability of the business in any given year. But throughout the investment cycle, you have to account for those investments. And therefore, real free cash flow you can generate on WageX is not as high as it appears on any given year. I would be cautious holding WageX for an extended period of time.
And is this a sector, because of the exposure to the tariffs, that you would stay away from in general? Or are there other ones you would sort of circle back around and look at maybe after tomorrow?
Well, the WageX in general is exposed to the very competitive, tough industry. So it's not a business that has characteristics of a multi-year compounder because of its high capital intensity, because of competition. And therefore, I don't think it can outperform the broad market as a whole if you're looking for the longer term. Of course, you can trade around it, and there's nothing wrong or immoral around it. But if you're looking for that compounding effect, that would not be the WageX.
Got it. Okay, let's go back to the phone lines. John's on the line from London, Ontario. Hi, John. What's your question today for Andre?
Oh, hi, Marella. Hello, Andre. I know you're dealing with caps, but my question was on the sectors that are leading us out of this tariff volatility. One in particular, asset managers, financial companies such as Berkshire Hathaway. He's got $300 billion on the balance sheet. He's buying back stock. He doesn't pay a dividend. Is this a good time to start accumulating more Berkshire Hathaway? Thanks very much, Andre.
Yeah, sure. Let me first address overall approach towards the tariff. So I think you have to be exposed to the companies that are not as much impacted by tariffs. If you're looking for a specific sector, I like to invest in technology companies because they're capital-light businesses. They're agile business models. They're usually highly sticky revenues, so high recurring revenue. And if you have a great management team, you potentially have a margin expansion as well. Of course, you want to make sure you don't overpay for this type of businesses. So that's the risk.
Which is hard these days, right?
Which could be hard. Yeah. And it has been hard to find high-quality technology companies which are not overpriced over the last several years. But you do have good opportunities these days, especially if they have been impacted by limited liquidity, which is across of Canadian capital markets to some extent. A number of these high quality tech companies are really available at very attractive multiples right now. As it relates to the Berkshire Hathaway, of course, we have the best capital allocator in the world and probably the best investor of all time overseeing that business. They're sitting on a record pile of cash. I want to caution you, though, because they have very high proportion of their businesses exposed to the private businesses. So the percentage of the capital in their books is not as big as it seems. You should not only look at their public equities portfolio, you have to consider their overall holdings, private and publics together. Berkshire is built to withstand the storm. And that's, of course, is the vision of late Charlie Munger and Warren Buffett. And over the longer term, they're going to take advantage of unique opportunities that are present in the market. And every 10 or so years, we have unique opportunities available. And they're going to utilize the record pile of cash to do something smart with that. I think that Berkshire is well positioned to outperform the broad market over an extended period of time. Even after Warren Buffett will be gone, I think that he has instilled the principles in the board and the people who's going to manage the capital that have those characteristics. So I have very high confidence that Berkshire are going to do better than overall S&P 500. So you have to compare it against the proper benchmark in this case.
Got it. Okay, we are going to take another quick break. We're going to be back to take more of your questions and also have a look at Andrey's past picks. That's when we return. Welcome back. Time now for past picks. We are taking a look at Andrey's picks from September 10th of 2024. And the first one at the time was Lumen, recommended at 36.21, up to 40.88 at this point. So a 13% positive return, 13% total return as well. A software solutions companies for media and communications. What have they been doing well?
They've been doing a lot of things well. They made an acquisition, which they integrated well, extremely well, as a matter of fact. They increased the margins, and they have proven their whole business model. That happened over the last several months, at the end of 2024, to be exact. By my calculations, this proof increases intrinsic value of Lumen Group to the extent of 30%. So the stock is up 13%, but I believe the stock actually intrinsic value should be higher by 30%. Therefore, it has gotten significantly cheaper from when I profiled it back in September.
So this is something you would continue to add to your portfolio at this time?
Lumen is a very, very strong buy at these levels. It's one of the best compounders in Canada. It's exposed to the very large market. The opportunity set to deploy the capital for them is getting bigger and bigger. I expect them to make a sizable acquisition this year and to once again showcase how they can deploy the capital at more than 25% after-tax rate of return. If you do the math, think about it. If you do the long-term DCF, discounted free cash flow valuation, and assume that they can reinvest their free cash flow at 25% return for, let's say, 15 years or so, which I believe they can based on my analysis, and discount that to the present time using a reasonable discount rate, you can make a case that Lumen's stock price should be $150 a share. If you look back and analyze Constellation Software, which is one of the greatest compounders in Canada, you can make a case that it has been expensive for the past 20 years, yet it's one of the best compounders in Canada as well. So the same playbook applies here. And I think the market really doesn't get it. Everybody's looking at the current EBIT to EBITDA multiples on the next year earnings. I think it's a really wrong way to think about this type of businesses, about the true compounders. And you have to build a long-term DCF and to figure out the value of that business. So that truly applies to Lumen. And Lumen has gotten cheaper over the last 6 months for the reasons I just explained.
Got it. Okay, let's look at your next past pick, which was Trisura Group, which is an insurance company at the time, 39.27, which was September of last year, and now at 33.64. So it's fallen 14%, total return loss 14% as well. What is going on with Trisura?
Trisura is a specialty insurance company.
Okay.
What they did is they have looked at their U.S. operations, and they decided that they want to terminate some programs which are not profitable. Because they've grown so fast in years, more than 100% a year, as a matter of fact, for some years, it's normal for them to identify the business in which they want to be and the business in which they don't want to be at all. Therefore, what they've done is they have taken a sort of a write-down. They allocated some capital towards this non-core business operations. And now they're focusing on growing a highly profitable business, which is generating very good combined ratios. So Trisura is doing a good job. I expect them to generate clean quarters over the next several quarters. That's going to showcase the confidence to the overall market that they really know what they're doing. They're generating very good combined ratios in Canada and in the US on a go-forward basis. Their book value per share has increased a lot as well. I actually expect it to compound its book value per share at high teens for the next 5 or 10 years. So it's a great, great buying opportunity. If it stays at these levels, I think it's going to be bought by somebody.
Got it. Okay, I do want to get to your third past pick, which is Knight Therapeutics. Again, September last year, it was at 604. Now it's up to 620. So it's a 3% return, 3% total return, and they license pharmaceutical products.
Yes, Knight Therapeutics, they focus on licensing pharmaceuticals in Canada and across Latin America. I think it's a solid hold over the longer term.
Okay.
And you can actually accumulate the stock on any pullback. They're buying back a lot of stock. Of course, the volatility of Latin America market is not helping in this environment, so that's something to watch for. At the same time, they bought Paladin Labs recently, so they made an acquisition. You can say that they went back to their roots to some extent. It's a different Paladin from before,
okay.
But Jonathan Goodman is the one who built Paladin Labs over the years, so it's very nice to do kind of a full circle and to buy it back, and now they own that business as well.
Because they have a deeper understanding of the business, they know what they're getting.
They have a complete understanding of the business. They really know what they're buying, and they really know how they can monetize that in a profitable way. So it's Knight Therapeutics is a solid long-term hold. They're exposed to temporary dynamics in Latin America. They're investing in growing the business, so a bit of patience is needed. But I think they're doing all the right steps while buying back a lot of stock.
Got it. Okay, we are going to take a quick break. Andrey sticking around to answer more of your questions in just a moment. Stay tuned. Welcome back to Market Call. Steve's holding on the line from Aurora, Ontario. Hi, Steve. What's your question today?
Yes, hi. Thanks for taking my call. I wondered what your guests' thoughts are on Magna International, given all the tariffs. Wondering if a lot of that possible negative news is more than priced in, and given its international operations, do you think there's an opportunity where that might represent a deep value? Thanks for taking my call.
Yeah, so Magna, of course, in a specific situation because of American exposure, and we're getting the announcements tomorrow as to whether the auto sector is going to get dinged.
Right. I don't think it's the right time to be buying into Magna for the reasons that it has a direct exposure to the tariffs. And also in general, if you step away and take a look at the business, it has a high capital intensity business. It's exposed it's highly competitive industry as well. And I don't think it's a compounder. If you think of the compounder category, is it something I want to own for 10 years? Magna would not make that cut. So you can make a case that there is a trade there and that tariffs concerns have been more than reflected in the stock price. At the same time, you have to reflect who would be the marginal buyers of the stock at this point, who would want to stick their neck out, so to speak, and buy into the companies that have direct exposure to the tariffs. And so far, I'm not seeing anybody who would want to do that. Therefore, I would expect this type of names to be flat to potentially down more until we have a bit more visibility.
Definitely, people are in a holding pattern to wait, I guess, until that deadline tomorrow or even the rest of the week and early next week, not only to see what Donald Trump announces out of Washington, but to see how countries respond.
Well, the news are so volatile and it keeps changing day to day, week to week, that you really don't know if it's positive news, is it here to stay, or is it going to change next week or next day? Therefore, I think you have to really subdivide securities into two categories, those that are exposed to tariffs and those that are not exposed to tariffs, so really marginally exposed. And I think it's a second category that you need to focus on, especially those that are being impacted stock price-wise, being put in the same category as everything else, so to speak. And I think that's where you want to be shopping. And that's where the fund flows from the Canadian allocators will be going, not towards the first category.
Got it. Okay, let's go back to the phone lines. John's on the line. He's calling from Saskatoon today. John, what's your question today for Andrey?
Badger Daylighting's been in a little bit of a range lately. Do you still think it's due to go up in the near future?
Yes, I profiled Badger as my top pick recently. Badger, I think, is in an excellent position.
Okay.
They do hydrovac excavation across North America. Most of the operations are in the United States. They also have some exposure to Canada, but not that much. Yeah. In the US, the business is really booming. The rates per truck are increasing nicely. Management has taken advantage of that. After US elections have taken place, there has been clarity from the corporates how to invest the capital in U.S.
Okay.
And despite the recent concerns around the tariffs, et cetera, these are long-term critical investments that they're doing. So I think Badger is in a really good position. And if it stays cheap as at these levels, I think it could be taken out by private equity or strategic buy.
Got it. Okay. Let's go on to Sal from Toronto. He has a question as well. Hi, Sal.
Yeah, my question is on Hammond Power Solutions. Last year did a fantastic job, outstanding growth, and this year it's been much more subdued. It just had earnings recently. I was wondering your thoughts on starting a position in Hammond Power, and if you could also talk about, in terms of the categories you brought up, would this be a company that would be sensitive to tariffs? Thanks so much.
Okay, so Hammond Power, we'll pull up the chart right now, is at 79.28. It's actually up $3 today, but over the year down 45%. So what's been happening there?
So I still believe in the Hammond Power story, and I think the pullback is an opportunity to accumulate the stock. They provide something mission critical, and there are very few alternatives to what they're doing. And if you believe in the whole electrification trend and limited power availability to really invest in high growth industries in the US, then the Hammond Power is really needed. Their products are really needed. I don't think they're as exposed to tariffs as some other companies because I think they have some pricing power. And they will exercise that pricing power. And I don't see any slowdown from the business standpoint for what they're doing. The stock might have overshot a little bit. It had a tremendous run over the years, over the last several years. But I think this pullback, you really want to take advantage of that and start accumulating Hammond Power.
Got it. Okay, we do have to take a quick break. Back with more of your phone calls for Andrey in just a moment. Stay tuned. Welcome back to Market Call. Dominic is on the line. He's calling from Montreal with his question today. Dominic, what is your question today for Andrey?
Yes, hello. Thanks a lot for taking my call. A lot is being said by our Canadian politicians about rebuilding Canadian infrastructure and our economy being more diversified. I'm interested in knowing if you think there's an investment case on Canadian infrastructure companies, and if you would recommend a couple of names.
Okay, thanks for the call, Dominic. So interesting question, because everybody's talking about building energy corridors now, building highways that link up with different coastlines and ports, getting access to the ports, because we are where we are with Washington and we want to sort of get away from some of that trade that we're dependent on. So is it too early to look at this kind of investment in infrastructure, or should we be looking at it now?
Well, first of all, I want to say we're finally waking up as a country, and it's amazing to see how everybody's coming together and talking about working together, dropping the barriers between the different provinces. We are charging crazy tax rates for the products to travel from one province to another. That makes no economic sense. We can unleash a lot of GDP if you just drop those and focus on doing the right thing. So it's great to see. It's great that politicians are talking about it. I'd like to see some action, of course, probably going to come after the elections.
We have an election first,
So we have an election coming first. When it comes to Canadian infrastructure investments, there are some good companies out there trading at attractive multiples already before accounting for any of those additional investments. So you really have to pick your spots. You want to make sure that they're not taking fixed price contract risk. That has been a big issue with the infrastructure company investments. But many of them have smartened up over the years, and they structure their contracts differently, where they're not exposed to those fixed price contracts. I think you can take a look at the Aecon Group. They've done a pretty good job over the years, and clearly will benefit a lot should this type of dynamics be happening across Canada. You can also get exposure to the consulting side of things. So that's probably even better way to play that and safer way to play that. Atkins Realis is a very good company based out of Montreal. They really transformed their business. They're exposed to the nuclear resurgence. It's approximately 20% of their business and growing at 30%, annualized. So we're seeing a lot of those nice investments happening on the nuclear side of things. And for the same reasons I mentioned earlier, we don't have enough power to do what we're trying to do. So whether it's investments in the new reactors or whether it's investments in restarting the old ones and refurbishing them, Atkins, the Realis will benefit tremendously from that. Okay. They are really subject matter experts on that.
Got it. Okay, let's go to an email. This is an email from Dean. He says, "Hi, Andre. Can I please have your outlook on NFI Group, please?" Again, that's from Dean asking.
Yes, so NFI has struggled over the years. What they do, they specialize in building the buses.
Okay.
They have a good exposure to on EV side of things. Now, my problem with NFI is that it has a lot of leverage.
Okay.
And you cannot ship the bus if something is missing. You're missing one component, it has to stay, so the inventory has been elevated.
And is this a situation where they rely on the U.S. for any of these parts?
They rely on the U.S. for some of those parts, absolutely, so they're exposed to tariffs as well. But the management has done a very good job in trying to work through their problems, to refinance the debt. And I think they're on the right trajectory to fix some of those issues. Now, you have to have faith in the management team, which I do, but also be comfortable with the leverage on NFI Group. So, but if they're successful in working through those problems, it can be very high performance over the next 2 years.
Okay. Let's get to another email then. This one's from Mike. He says, please provide your thoughts on EQ Bank. EQ Bank.
So EQ Bank is Canada's seventh largest bank. Andrew, the CEO of EQB, has done a tremendous job over the years. They have built a very differentiated offering from the rest of the Canadian banking system. It's a digitally native bank. They don't have branches, so you cannot find them.
Everything's online.
Everything's online, that's right. Walking around downtown Toronto, Montreal, you won't find any of those branches.
How do you feel about that? Because I know some people are saying, you know, they like the bricks and mortar, and if you can't see them and touch them or go in, are you ready to invest in them?
Well, they've done a great job. They have a balance sheet strength. They have a diversified funding sources for different channels. They have a digital bank offering. Online, you can go in, you can get very good rates, as a matter of fact. The EQ Bank card, if you transfer your payroll there, gives a lot of different benefits. So the number of clients are growing nicely. Their funding is being diversified. I'm not too worried about the credit quality as well. So they've done a tremendous job managing the credit exposure.
How long have they been around, roughly?
Oh, they've been around for a long time, 15, 20 years.
Okay.
So they've been around for an extended period of time. And I hope it stays public because I think it's cheap for what it is. It can generate high return on equity for an extended period of time. And actually, EQB is the best performing bank in North America over the last 10 years. If you look at the total shareholder return, which includes the dividends, they have compounded the capital at approximately 15% annualized. And that's actually is almost exactly equal to the book value per share growth rate.
Got it.
And I expect them to be able to compound the book value per share at 15% CAGR over the next 5 years plus.
Got it. Okay, let's get in one more email. This one is from Rick. He says, it is looking like a downturn in the economy is quite possible. I was wondering about your guest's opinion on companies like Go Easy, which is another lender and I guess lends to people that maybe get turned away from banks?
That's right. 50% of their business is non-prime lending, unsecured lending. Now, we have had a regulatory reform in Canada, whereas the maximum interest rate you can charge is 35% for those type of loans. Go Easy does a tremendous job in helping people to rebuild their credit. Somebody who has had a bruised credit experience needs to go for the company like Go Easy to be able to become a credible borrower once again, to do business with the Canadian banks, with the Big Five, for example. Go Easy can reprice their loans pretty quickly. In a matter of 2-3 quarters, they can really reprice and adjust their credit experience as they see fit. And that's one of the reasons why they have not had big losses over the years. There's a misconception around the risk of Go Easy going into the economic downturns. Because of the ability to reprice the loans and take the credit that they want, it's not as exposed as people think. And right now, big banks are turning people away. They're worried about overall economy. consumer health, of course, is something that we are all worried about. But as a result of that, GoEasy is able to pick the best credit quality at the best rates, and they're growing their loan book at very high rate as well. So it's a great company. It's a tremendous compounder. I have faith that they're going to survive this, but the stock price is volatile because of these misconceptions around GoEasy.
Got it. Okay, let's take a quick break. When we come back, we will have Andrey's top picks. Stay tuned for that. Welcome back. Time to share Andrey's top picks. We'll get right to it. Topicus is his first pick, which is an enterprise software company. Tell me why you like Topicus.
Topicus is a spin-off from Constellation Software. They're focusing on doing what Constellation does, but on the European market. They have very good total addressable market.
Okay.
They're growing organically at a nice rate, about 5% organic growth rate, which is very good for this type of services. And they deployed capital, especially this year. They already deployed a lot of capital at very good rates of return. I think it's a mini Constellation of Europe. And based on my earlier comments around Lumen Group, which is another spin-off from Constellation, these businesses are not properly valued because you really have to do a long-term discounted free cash flow valuation and to incorporate accretion from M&A that they're able to do. On that basis, it's one of the most exciting compounders in Canada, and you can hold it for an extended period of time.
And you're talking sort of 5-10 years?
I'm talking about 15, 20 years,
15
frankly.
or 20
That's
years.
right.
Got
yes.
it. Okay. Let's go to the Boyd Group then, which is your second pick. Boyd Group, collision repair centers. It's an interesting one. So they basically manage and fund these centers. What kind of business is that? Meaning, is it cyclical or is it steady? How does it work for Boyd Group?
It's usually pretty steady business. Auto repair collision is something that happens on a regular basis. It's driven by various factors, such as weather conditions, for example, but it's also impacted by the insurance premiums. So what we have had recently is a spike in insurance premiums, and as a result, the submission rates have really dropped a lot. So the industry has been in the recession, so it's not doing as great as some other companies I spoke about, but Boyd is doing a tremendous job in managing throughout that tough environment. They're gaining a lot of market share, and they're investing in greenfields and brownfields operations, which have very high return on invested capital attached to it. So the industry is not in a good state. The cycle has been overextended, but at the same time, you can only postpone repairing your car for that long. At some point, there's normalization of insurance premiums increases, which we're seeing already, and there will be a natural catch-up in some of the submission rates.
So I imagine some people, if the insurance has gone up, that they're just not getting their car fixed, as you mentioned, routinely, or they're avoiding some of it that they don't have to get done right away, but you're saying they will have to get it done eventually, so you see a catch-up there.
There's a bit of a catch-up element to it, but some of that will be lost indeed. That's the way the industry operates. Now, Boyd actually stands to benefit from the tariff discussions that they have had throughout this program, because if used car prices increase as a result of all this tariff situation, there will be less write-offs of the vehicles. As less write-offs happen, you need to repair them more frequently. So that plays in the Boyd's favor, because there'll be more repairs happening.
Interesting. Okay. Let's get to your third pick then, which is Constellation Software, which a lot of people do like, trades on the TSX, of course. What do you like forward-looking for Constellation?
I decided to profile a large cap company as one of my top 3 picks, because Constellation is truly one of a kind. It's one of the best compounders in the world. They invented the whole market of vertical market software consolidation. And I think the big misconception around Constellation Software is that that total addressable market is not as big, or they cannot deploy the capital at the same rates of return going forward as they have in the past. So I very much disagree on the TAM front. I think the total addressable market is huge, and they can continue deploying capital. Of course, if they make larger acquisitions, they cannot expect the same 25 or 30% after-tax rates of return attached to those, even after you apply Constellation playbook to those. But on a blended basis, I think it can compound the capital at still very high rates of return. And I think I want to highlight that we are very blessed to have a company like Constellation Software trading on Toronto Stock Exchange and be based out of Canada, because it's a true champion. It's one of the best compounders in the world. And we can all learn from their playbooks on how they do allocate the capital. And that's why there are two spin-offs, Lumen Group and Topicus Group, I spoke about extensively, I think are completely mispriced by the market. And there's a misconception around how to value those type of businesses.
So would you, at this point, pick Lumen and Topicus over Constellation if you were investing? I mean, this is obviously a top pick, so you want to invest in this. And sorry, I'm running out of time, so 15 seconds or less. Which way would you go?
I think you want to own the whole ecosystem, but if I had to pick the one that's most exciting today, that would be Lumen Group.
Got it. Andrey, thanks for coming in. Appreciate your time. We'll see you again soon. And we are going to leave it there. Thanks for joining us here on Market Call. We'll be back again tomorrow. See you then.